All of this just screams market crash, annihilation. All these poor retail investors just get lured in for big returns because they don't understand risk and many haven't been through a bear market or a reset. And then they just get blown up. I'm trying to save people from doing that.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next.
Chris, thank you very much for joining us today. How are things in Toronto?
I'm great, James. Thanks for having me. And yeah, things are good. We keep having snow overnight, but it's gone by the end of the day. But the ski hills are a little bit white, so I'm getting excited for skiing, snowboarding with the kids.
That makes two of us. So let's jump into it. The markets have been under pressure the last few days, and it looks like it's going to continue today. I just watched an interview with Jeffrey Gundlach, the bond king, and he said that this market, the current market environment that we're living through right now, is the least healthy that he has seen in his career. He's suggesting to investors that they go 20% cash. So I want to get your views on that and what you think. But the S&P is still up 12% on the year. The Nasdaq still up 15% on the year, give or take. And why don't we just start right here with the S&P and take a look at this chart and where you think it might be going during this period of pressure?
Yeah, I mean, I think I agree with a lot of that. I think the markets have been unhealthy for a very long time. And of course, the higher they go, the more unhealthy they become, just because of earnings ratios and the amount that certain stock sectors are doing most of the heavy lifting, like the AI, the big tech. But when we look at the S&P 500, you can see the market looks like it's starting to roll over here on where we are. I mean, we closed out some of a QQQ position and exited the QQQ pretty much right up near the high here on a temporary trade. We've closed out our SP 500 position. This market looks like it could start to roll over. The trend is turning down. In fact, if we look at like the Nasdaq here, you can see this is this past year where the trend changed direction. We went into that February tariff sell-off. Well, we've already seen the market change direction here, and this time it looks like there's potential for another big precipitous fall. So this chart here, this red and green, is based on technical analysis. It's based on cycles. It's based on money flow of where money's moving in and out of this market and how aggressively. So, when we look at the S&P 500 from this view, you don't want to be holding stocks right here at this point. I mean, long term, we're still in a bull market long term, but the short term chart like this is saying, hey, we could be going into a 5 or 6% correction, or we could be going into a 20+% correction. So you gotta protect yourself at this point.
And Chris, so right now we're looking at the S&P.
Yeah.
That blue line, is that the 50-day moving average?
It is, yeah.
And could you put up the 200-day moving average?
Yeah, let me see if I can pull that up here.
And once again, I want to look at this just to see a possible level where we might find some support, if in fact it does go there.
Yeah, so there's the 200-day loaded up, the pink line here.
Okay.
So, I mean, that's a pretty good.
So we're currently at 6,600 on the S&P. What's the level on the 200?
The 200 is 6,300, and it's about a 5% pullback from where the market is right now. So it'll be a pretty good dip if we get down there.
And so, do you envision this happening? Do you think we're going to test that in the next few days?
It's possible. I mean, when we look at a lot of sectors, most sectors are, I look at about 40 different sectors. And when you look at them all and their money flow, most of them have money flowing out. People aren't willing to put risk on into those sectors. The long-term trends are actually turning down. In fact, we have my hot list here gives us a good gauge. So if we look at this sentiment column down the right-hand side, if it's red, that means money's flowing away from those sectors and people don't want to be involved in them. And so that's not a good sign. Most of the sectors money's flowing out of. The trend in the middle there, the up or down, this is short-term analysis. Sectors are now in a downtrend. And from a long-term stage analysis point of view, from a bull or bear market point of view, most stocks, 2/3 of sectors are actually in a topping or a downtrend in a bearish phase. So you definitely don't want to be holding stocks in this particular market environment, just because the momentum is turning around. And I think we could see like a 5 to 15% pullback from where we are right now. So down to the 200-day, potentially even go a lot further, very similar to what we saw in 2007. And during this window, if the stocks do sell off, I think we could go and actually see precious metals really come to life and start to rally.
Now that's a big range, 5 to 15%. Why
Yeah.
such a wide gap?
Well, I mean, nobody knows the range. I mean, the market is very overbought, right? Like it's had this massive move up without any real significant correction. The last time we saw something like this, the market had a 20+% correction before. Obviously, that was juiced up with the tariff talk, but I think we could easily see this, down to the 200-day, another 5% from where we are. But if things get really ugly, and say the momentum changes from, like right now, the AI and the technology space has been holding the markets up. But once that tide turns, once money starts really daily and weekly exiting the AI space, it's going to pull the S&P 500 and the Nasdaq down dramatically. Everybody was emotional piling into AI stocks. They've driven the whole stock market higher, but it's going to be the same when it turns around and people get scared. They're all going to do the same thing. It's a herd mentality. And when, everybody starts dumping Nvidia and starts dumping all these other companies because they're scared, then, it's going to pull this market down sharply. And it's when everybody exits the same sector at the same time, especially when it's the heaviest weighted in the indices like technology, it's going to do a lot of damage. So, I mean, you have to give a range. I think we could be 5 to 15% down from here. And you just have to let the market's going to do what it's going to do.
Okay, I want to take a look at Nvidia, but before we do that, why don't we just take a look at the Nasdaq?
Sure. Yeah, when we look at the Nasdaq daily chart, it looks pretty similar to the S&P 500. We're getting into, we're in a very similar market environment as right here, and it's the same with the S&P 500. I think we're very close to, fairly significant pullback, and it's going to come potentially back down into these highs, into this area. And that's going to be that, 5-10% pullback. And the Nasdaq is usually more volatile. It's more focused. It's definitely more tech heavy. But again, it's the same thing. I always look at the stock market as the tide's going up or down, and all the indices are the same, and most sectors are the same. They all move with the stock market. If there's a huge sell-off, every sector pretty much goes down. There might be one that bucks the trend, but so whatever happens in the S&P 500 is going to be the same as what happens more so in the Nasdaq and the Russell and the Dow. They're all the same trade. Stocks are stocks. You either want to own equities or you don't want to own equities. That's how I like to look at things.
So why don't we move on now and take a look at some of these chip stocks, starting with Nvidia. They're going to report this week, I believe tomorrow, Wednesday the 19th, after the close. So that's going to be quite interesting. And as you mentioned, this AI has been driving this entire market and the economy. And I just read a report that said 90% of the GDP growth we've seen this year is CapEx spending, okay, from AI and all these data centers. So when you look at Nvidia, it's still up 35% on the year, but what do you make of this chart? Where do you see the risk on the downside?
Yeah, it definitely, it's at a critical pivot point. You can see how the price was stuck below this blue line and then suddenly it got above it. And if the market's not happy with what's going on, I think we could see a very quick flip to the downside. I think we'd be back down to this 200-day very quickly. Just the volatility of this move, if you're to just take the height of that move and carry that to the downside, you could see where this could flip very quickly. And percentage-wise, I mean, that'll be a pretty decent haircut from where it is. That's about a 17% haircut, which will pull the stock market down dramatically. If Nvidia crashes, a whole bunch of AI stocks are going to crash a whole lot more and go with it. So, I mean, you talk about the data centers. I was just reading an article on it. The amount of money going into like infrastructure and data centers is just, it's mind-boggling. And, compared to that to like money going into like commercial like office space, which is the complete opposite, right? Everybody wants to go into the AI and data center space. Nobody wants to get into like commercial or office space. So we definitely have this huge change going on in the economy and how we work. Most people now work from home, it seems. and everything is data and digital. So we're definitely in a huge turning point. But the AI space, the amount of money going into it versus the profits these companies are making, I mean, the profits I don't think are there yet. And I think they're a long ways away. So I think we could see some of this air get let out of this balloon, this bubble here over the next, I think the stock market is very, very close within potentially weeks or a couple months from a major market top, if it hasn't already started a top. Like, I feel like that's how close we are. And I think if the stock market is topping here, this will be like one big last push, I think, higher in the precious metals space, which we saw in 2007, where gold shoots up dramatically, about 25, 27%, silver maybe 50% higher. So there's I think we're at a very critical juncture in this market.
So let's just continue on with the chip theme. Another one that's done very well this year is Micron. It's up 180% this year. What do you make of this chart? Yeah,
when we take a look at Micron, once it loads here, it's had a huge move to the upside. I mean, I don't follow this company individually. I remember I used to day trade it a decade or two ago, but it looks like it's obviously getting some volatility, meaning it's had a very nice trend to the upside, but now it's rallied up and then it got sold off and then it rallied up and hit a nominal high, so a minor new high. Now it's getting hammered again. That's generally not a good sign. That's a sign that people are starting to sell. It looks like it's losing its momentum, meaning it could easily roll over and sell off. So I'm not a big fan of this type of chart price action. It's a sign of weakness.
And there's one more I want to look at, and that is SanDisk, SNDK. This one just blows my mind. It's up over 600% on the year. I wish you told me to buy this one, but
no kidding.
This reminds me so much of what we saw back in the early 2000 or the late 1990s with these .com stocks. Like, look at that thing.
Yeah, it's huge. I don't know what the news is. I mean, I don't follow individual stocks anymore. I really focus on the overall tide of stocks, bonds, currencies, and precious metals and things like that. But there's obviously something's happened. I don't know what the deal was or what they've done, but everybody has definitely been piling in. We have the same scenario here, lots of volatility. So a huge pop, sharp sell-off, another huge bounce, another big sell-off. Volume is the highest it's ever been. So this is a sign that it's a crowded trade. It's obviously bulls and bears are now fighting. And when something is in this type of move, kind of like this bubble phase, you've got to be very, very cautious, because what goes straight up can come straight back down. And the monthly chart generally gives us a good view of everything. So here's the monthly chart. I mean, that's not a healthy type of price action. That's what investors want to see. But holding this type of value, especially if the stock market and the AI bubble is about to let a little air out of the bag, this could come tumbling down very quickly. It's a crowded trade, everybody piling in. They don't care what price they buy it at. Well, they're going to be the same mass exodus on the way down when people are like, oh my God, I can't take this anymore. I'm losing so much. It feels kind of like one of those, a big crowded like meme type of play. So anyways, I'm not a fan of that either.
One more name. Why don't we take a look at Microsoft? It's up 20% on the year. It owns 27% of OpenAI, which owns ChatGPT. So it's a good proxy for OpenAI. What do you make of this chart?
Yeah, I'm not a fan of the chart. I think Microsoft's a great company. I think they've got solid revenues, solid business model, but I'm not a fan of, this double top. Both of them happened with a massive gap up and then just got hit with big selling. Another couple big gaps right up into resistance again. It's been hammered with big selling. I feel like this stock, that is a double top. Like, that is a sign of exhaustion, of big sellers unloading shares. And it looks like it's already kind of more so breaking down. We just draw a line across here. It does not look good. And generally the depth of whatever this is, I mean, this is the most basic technical analysis you can do, but the height of a topping pattern, you can usually flip that to the downside. And that brings us down to 440, which brings us into this little cluster and these previous highs. So that'll be a pretty big unwinding in Microsoft. And these big companies, some of these big companies, when they sell off, 15 or 20%, and a whole bunch of them do it at the same time. They're kind of all the same trade. This is what causes that 15 to 20% pullback in the stock market. So that's what people need to be aware of. You need to have an exit strategy. If you're not out already, you need to protect your capital, because eventually one of these pullbacks in the stock market isn't going to be just a buy the dip and hold on and you'll be fine a couple months later or a couple of weeks later. It's going to be you're going to buy the dip. It's going to keep falling. You're going to lose half of your portfolio. You've just wasted 3 to 5 years, maybe even longer. And so that's what I focus on. I'm like, how can somebody protect their capital from having it devastated and changing your lifestyle? And we got a lot of big signs in these big tech and AI companies that are not looking good, and they are going to crush the equities market when they fall.
Yeah, just one comment on this Microsoft chart. It does look like it's a lot more advanced to the downside than those other charts we looked at, Nvidia, Micron, and SanDisk. And it looks like maybe because of all the circular financing that's been going on with OpenAI and so many other names, that's why large institutional investors have been selling this name. Do you see the possibility, there's a gap down there that we saw back in April, May. Do you see the possibility of the stock going down there and filling in that gap on the downside?
Yeah, I think if we go into a bear market and finally we have like a financial reset, I mean, we can zoom way out. I think stocks are going to go way beyond that. I think we could see. I think the market will probably want to pierce this low. It means it's going to want to come all the way down into this level, break this low, which will create another big massive wave of panic selling. This level here, I mean, the market loves to apply maximum pain. So this is a very critical turning point where it became major resistance, now became massive support. If we go to a huge recession, I think we'll see Microsoft want to break this low. And anybody who bought through this whole phase through here are going to be looking at that low saying, if it breaks that low, it's like, oh my God, this is going to be brutal. So that's what will create probably another wave of selling, which will potentially want to pierce this next low down here. The markets are always trying to make higher highs or lower lows. It's trying to break standout highs and lows. So I think we could see a huge haircut across the board. I don't care how good the companies are. And I've done this many times in detail about dividend stocks and the dividend sector ETFs, where you focus on, most people focus on big dividend companies. They get hit the hardest. And even though they're some of the strongest companies, pay the most money, they're rock solid, the share prices still get absolutely annihilated. And it's because most of the money in the US equities market are baby boomers, or they're 50 plus people with money. And they're all invested in the same stuff, right, Jim? They're all invested in dividend stocks, and they're diversified across a bunch of stuff. But they all are also in the same boat. So when they all start to panic, when things sell off enough, and they feel like their lifestyle and their life savings are threatened, they all start to call their brokers and start to sell positions. And they all own the blue chips and the dividend stocks, which are the Microsofts and all of these, right? So those stocks get hit really, really hard. Right when you think you've got the best company, you realize you're holding one of the most volatile ones. And we saw this during COVID. Stock market pulled back 35%. Well, if you own dividend stocks, they pulled back on average over 40%. So these so-called safe companies to get a yield carry a lot more volatility than most people expect. And I mean, that's I'm not a big fan of diversification. I'm not a fan of buy and hold. I'm not a fan of holding dividend stocks. If you've been buying them in the last 5-10 years, I think they're great to buy after a recession, because then you're making 8 to 15+% return in your dividends, plus lots of upside. But holding dividend stocks right now are a ticking time bomb for a retiree.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's hardassetsalliance.com.
All right, so let's just make the assumption the markets are going to come under pressure here in the next few days or the next few weeks. We got to put our money somewhere. If we take it out of the S&P and the Nasdaq, you mentioned gold. It's up 50% on the year. What are your thoughts on gold now? Do you think there's more room on the upside, or do you think it's going to come under pressure like so many other asset classes right now?
Yeah, I think gold is going to. I think gold's going to go a lot higher. I think, in 2007, we saw very similar price action in terms of what the S&P 500 did, what gold has done, what the US dollar is doing, plus the sentiment is very similar. People have been very bullish on equities. They're really super bullish on the precious metal space. The dollar is super hated. I think I think you just kind of nailed it there, Jim. I think we're going to see, for example, the blue line I'm about to draw would be the stock market starts to sell off 5, 10, 15, 20%. And the money is going to come out of equities, and money is always looking for a return on investment. So it's going to go out and search, where can I put my money? And precious metals have been one of the top performers. So all that money coming out of equities is going to send gold sharply higher, along with silver, platinum, palladium, and miners. And I think we could see gold run to about 51 or 5,200. So we're looking at about 27, 30% to the upside for gold. And this could all happen really within a 2 or 3 month window potentially. So we're very close to another explosive move in this space. Silver is very similar. I think silver could run 50+% up into like $82, an ounce fairly dramatically if this unfolds like I think it's going to unfold.
So if we do get a pullback in gold, I'm sorry, where's the 200-day line? Let's just assume that's where we're going to find support.
Yeah. Well, I don't know. Yeah, I mean that would be a very good support level at this point. That's way down here at 3,500, which is also the breakout zone. I don't see gold pulling back down there. This blue line I just drew here, that's me just drawing if this was the S&P 500 selling down, all that money would be going into gold. So don't look at that. That's not what I'm expecting of gold. I'm expecting gold to go higher as the stock market goes down.
And I'm sorry, you mentioned in 2007 when we saw the great financial crisis. What happened to gold then in 07, 08?
Yeah, I mean, if we look what happened back then, I'll just pull the chart up so you can get a visual here. So for example, if we just go back to 2006, 2007, stocks rallied up to all-time highs, gold rallied to all-time highs. The right-hand chart is exactly where we are right now. That yellow line is gold. The candlestick chart is the S&P 500. So we started to see some weakness right here in the stock market. We're just starting to see some weakness right now in current day price action. And as the stock market in 2007 sold off 20%, all of that money went into gold and sent gold higher. So I believe we could see something very similar. The stock market starts to sell off. That money then suddenly says, hey, I'm going into gold. They buy gold, silver, platinum, palladium, and they start to rocket higher. And if we look at these charts, like just take a look at what has happened here in terms of these other asset classes. So if we look down here, we got GDX, which is gold miners. We got silver, platinum, and palladium. And in this very similar scenario in 2007, we saw a lot of money move into gold miners. It got the attention of investors, and then it had a pullback. We saw the same with silver, and we saw with platinum, and we saw with palladium. And if we go and we look at where we are right now, and we just look at that chart, everybody has piled into miners, silver, platinum, and palladium. And what happens after this is the stock market, if we look at 2007, the stock market starts to sell off. And we end up seeing the precious metal space, all of them rallied 30, 40, 50, 60% from where we are right now. So I really like precious metals at this kind of junction in terms of over the next 1 to 3 months, we could see a very strong parabolic move in gold and silver that I think should eventually be sold into, because I do think it'll get sold off, because what'll happen is eventually we'll see the stock market sell off, which last time it did this, it sold off about 50+%, and gold and silver sold off as well. They'll eventually get pulled down with the fear and with the mass selling in margin calls, and gold pulled back 34%, which isn't massive compared to 55% in the stock market, but silver pulled back 60%, and platinum and palladium pulled back like 60% as well. So this is the sweet spot, I think, for metals, an upside trade in metals. It's a trade. I think once we have this blow off phase, I'll be looking to liquidate, close out a lot of my gold position, or all of it, and then look to reinvest later once I think it's, the airs come out of the precious metals bubble at some point.
And I know you trade ETFs, so you're long GLD or the Fizz.
For when it comes to precious metals, I have physical gold and silver only. but we do trade GLD. We did a GLD trade just recently, which we've closed out. We did a very quick trade right here. We played the breakout. We got out right here on this peak. We hit our 15% target, and so that was a quick trade using an ETF. But I only hold physical metals in terms of precious metals going forward.
So you don't own any miners?
No. There'll be a time, like I believe that when we see gold have this correction, this eventually once gold tops out and then we see a big sell-off, that's when I'm going to be excited more so for miners. I think it'll be something similar to this. If we go back in time to 2008, which just have to zoom way back here, I think we're going to come into. So in 2008, we saw gold pull back 34%. And that's what I'd be waiting for, is for gold on the current price chart to top out at 51, 52 somewhere, and then sell back down. And then I'll be looking to get into gold miners somewhere down here, because then I believe we're going to have a multi-year, like that's when we can see gold and silver really take off. I mean, I think we could extend to like that 8, 10, 12 something $1,000 that could go out for many years. And so this is the phase. The last time I traded miners really was in this phase. I want to get into this new super cycle where gold and silver go up and to the right forever. And that's when you can get into the miners and catch, a lot of them will move hundreds and some of them will move thousands of % in that phase. So I don't think miners have had a great run. They're still moving higher. But before I get into miners and trading individual stocks, I kind of wait for specific major setups to take place, because I'm not a big stock trader anymore. I really focus on managing ETFs and not a whole bunch of individual little companies.
And Chris, do you mind going back to the gold chart again? I just want to clarify where you think it's going. Okay, so
yeah,
right
so
now
if
you're still bullish on the gold price.
I'm still bullish on gold. If we just take this recent, let me just clear this chart real quick here. If we use Fibonacci extension, we can get a gauge of where this next upside move should be. So based on the recent rally and pullback, this is telling us we should be looking for gold to go to around 5150 to 5200, somewhere in that range. And from where we are right now, percentage wise, it's looking at about 26% to the upside. So that's where I think gold is going to go. The question is it going to do one of these? Is it going to flag sideways? How long is it going to do that for? I think it's kind of, digesting this recent run up. The sooner it breaks out, the better. I'd like to see it turn a corner and start to run here into the end of the year versus drag out for a long time. But we just have to kind of wait and see. The precious metal space did get pretty frothy right over here. We hit a Fibonacci target, which is where we got out on our gold trade. And after that, it just turned into a feeding frenzy that if people didn't have anything in metals, it was this like week and a half, these 2 weeks where the whole world seemed to just want to pile in. They didn't care what price. And so it got too crowded. And now the market's shaking them out. And now people are still nervous about precious metals putting in a top. So it's trying to work that out of the system, get all those weak hands out who give up on it. And then as soon as they get out, then we should start to see this run higher.
I recently sat down with a money manager. He manages $10 billion. He has a 20% weighting toward gold and gold miners. And in spite of the move we've seen this year in both gold and silver, he said none of his clients are asking about gold. No one in his office is really asking about it. And I thought that was interesting.
Yeah, well, I mean, when I say everybody wanted to pile into gold over here, it's not the whole world wanted to pile in. It's only the people who are open to the idea of investing in gold, period. It's a very small group of people. Most people don't own gold, and if they do, they have a tiny amount of it, and they don't look at it as a huge moneymaker. They just look at it as some barbaric investment, right? That's how a lot of the natural general public see it. So, I think there'll be a time that eventually we'll see gold rally up, and then potentially we go into a big pullback after we have some type of recession or reset. And then as it starts to take off and it starts to head up towards potentially like $10,000 an ounce or something, that's when the mass market actually start to get involved in it. And that's when we finally see like the average portfolio might have like 1.5% or 3% in gold. And that's when gold will put in a massive long-term high again. But right now, I mean, the majority of people who hold gold, like the average percentage in the portfolio is like less than 1% or less than 0.5%. It's tiny. Like most people don't hold it. So that's kind of where we're at right now.
All right, Chris, let's take a look at silver. It's up 70% on the year. Everybody's making a big deal about it because it went through $50.
Yeah. There's a psychological level at $50, $100, right? Every $10 is also a psychological level. You could argue here it looks a little bit like a double top, but I still think the chart looks very strong. It has a lot of momentum behind it, and it's just kind of working off a bit of an overbought territory. And I think it's also flirting and messing around with this $50 level. So many people put so much emphasis on, $100 or $50 mark. And so I think there's just a lot of people buying and selling around this $50 per ounce level. And the market's just trying to figure it out, and it's just kind of digesting it. But I do think silver will follow suit with gold and be up and to the right and have a fairly significant move.
And even though it's up 70% on the year, we got to remind our viewers, this is where it was in 2011. So adjusted for inflation, it's still down, to where should it be? Probably adjusted for inflation, $75, $80 an ounce. So it's still way underperforming gold.
Yeah. And my chart analysis, I think, points to it somewhere around $82 an ounce, which if it was to blow off and shoot higher up there, I mean, that would put us right in line with where it should be, right? So, silver's got these very explosive moves. When you go back in time, you got to be aware. Like, I'm always nervous of things that go straight up because it's pretty obvious what happens after that momentum comes to an end. But it doesn't mean silver's put in the top yet. Silver could still run, up to, it could have this crazy huge move somewhere up into this $80 per ounce mark. It'll dwarf all of these other ones. It's exciting.
Okay, so we can't have a discussion on gold without talking about digital gold or Bitcoin, and it topped out at 125,000. It's now trading around 90,000, give or take. Who knows where it is right now as we speak, but it's down on the year. What are your thoughts on gold? I know in the past you've been negative on it.
Yeah, I'm pretty negative. It's starting to look a little bit like it's had enough of a move down that it's going to kind of digest things a bit. I think we might be coming down into like one of these kind of phases, right, where it might mess around down here for a while and try and figure out what it's going to do. It looks ready for some type of bounce and consolidation, but it definitely, I think we could see this bounce up in here. The big question will be, can it hold this level? If it starts to break down from here, we're going to have a very, very big precipitous fall. We're going to have this huge amount of move that it's already come down. We're going to have that move, I think, unfold again to the downside, which will break this low, which will bring it down into this long-term support zone. So typically, like the way the markets move with kind of cycles, if it has like this cycle to the upside, well, usually it's going to keep having those similar percentage cycles to the upside kind of over and over again. But when it breaks down and that cycle breaks, you pretty much take that momentum cycle back to the downside. And so you get not only the first cycle sell off, but then you get the second half. So it gives you twice as much of a move, which is obviously what clearly breaks a long-term trend from up to down. So I'm short term, I'm a little bit bullish on Bitcoin. I think it might have a little bounce. Maybe the equities markets also have a little bounce. They're a little oversold, but I do think everything's going to roll over and then continue to go a lot lower over the next couple of months, which kind of goes against seasonality. Seasonality for the stock market is higher into the end of the year, but I mean, I've never traded based off seasonality. It's not very accurate. And Bitcoin moves a lot with the stock market. So if AI and Nasdaq are going to bounce and then sell off and go lower, Bitcoin is probably going to be dragged down with it.
Yes, I've never traded Bitcoin, but I have to say I wish I did. But every time we see one of these pullbacks, and we've seen many of these pullbacks where it's down 20, 30, 40%, it just kind of finds a level and then it takes off again. I mean, it wasn't too long ago when it was at 65,000, right? And next thing you know, it just rips to 125.
Yeah, these are long patterns though. I mean, these are like it takes 9 months to unfold some of these, or that's a long time. I mean, I'm not Yeah, but there's no doubt it's been in a strong uptrend, and obviously when you're in an uptrend, all these sell-offs eventually get bought back up. But again, if the trend breaks, if we go into a bearish environment, this will probably be back down at like, $60,000 or $40,000 next year. So you don't want to be on the wrong side. You don't want to just buy and hope. That's not what I do. Eventually, a pullback turns into a crash, and you just don't know which one it is, and it becomes very costly, not only for time, for money, but also more so time. You can waste a lot of time being stuck in a crappy investment and just wish you just sold it and moved on.
Yeah, to me, Bitcoin is just a leverage play on the Nasdaq, and it appears right now the Nasdaq's under pressure, so it's risk off, and Bitcoin is just following that trade. Now, we can't talk about Bitcoin without talking about MicroStrategy, which is now called Strategy, and a big part of what they own on their balance sheet is Bitcoin. It peaked at $400 this year. Now it's at, where is it, $200?
Yeah, 210. Yeah.
Okay.
Yeah.
So this one kind of reminds me of the Microsoft chart, because it's like Microsoft has been leading on the downside, and this one also is leading on the downside.
Yeah, it doesn't look the greatest. I mean, Bitcoin has lost a lot of its. Bitcoin was a feeding frenzy right back over here. Like, I have a lot of different tools to get a gauge on how hot and heavy somebody is over a specific asset class, and it was a feeding frenzy, just like this. Now, Bitcoin's last big bounce and rally, and this symbol moves a lot like it, is just showing there's not the same amount of interest. There's no volume. People have just lost their. Bitcoin is not top of mind anymore. Yeah, everybody knows it, but it's not. People aren't interested in it. I think a lot of people who are in precious metals went to crypto. Now it's like, crypto's kind of losing its shine, and now everybody's moving back over to gold, and they want to be in something that's performing, right? So Bitcoin is definitely not looking good. This stock doesn't look good. I mean, I've never been a fan of this stock. I'd rather just trade Bitcoin versus, someone with a stock symbol based around it. And I hate it when people hype stuff up.
So I mentioned MicroStrategy, but I believe I read there's over 100 companies that have taken on Bitcoin onto their balance sheet just to copy the strategy that Michael Saylor has done. And it's amazing. Like, there's so many landmines out there, right? And this could be a big one. Like Michael Saylor just did an interview recently. He said his average cost of all the Bitcoin is $70,000. Okay. And we both know it can get there pretty quick, but
yeah.
You just don't know what's going to happen, right? And he's taken on a lot of debt to buy that Bitcoin. So if we do get a major washout in the S&P and the Nasdaq and Bitcoin, there could be a lot of destruction out there.
Well, you bring up a good point. I mean, typically once you have a whole bunch of people copying the leader, usually that move is pretty much done, right? So now everybody's doing the same thing, as you just said. And that means it's a crowded space. It's already over. It's the same when you have a big move in a particular asset class, like gold miners, for example. In 2011, gold miners were on fire, and a 3x ETF gold miner comes out. So you could jack it up. And then, of course, the whole market kind of tops out. You see this all the time. Like, when people start copying a strategy like MicroStrategy, or a sector or a commodity does really well, and then suddenly a leveraged ETF pops up for it, like a 3X. I'm like, okay, now it's like, it was hot. Everybody was excited about it. Now they're creating a tool to try and profit from it. And that usually means the end is near. And so I think Bitcoin is done for a while. I mean, it might bounce and rally here and there significantly, but I don't know about going to all-time highs anytime soon. So I'm always leery once the mass psychology picks up and people start to copy and try to leverage the recent movement, because that recent movement is a kind of a one-time thing. It usually fizzles out and it never comes back to life like it used to.
Yeah, you mentioned the leverage ETFs. I had a conversation with a ETF PM last month, and he said in 1 week alone, in the month of October, there was over 200 filings with the SEC for 5 times leveraged ETFs.
5 times?
5 times.
Yeah,
and
that's not good.
Yeah, and I'm not sure if you knew this, but there's a lot of leveraged ETFs on single stocks. So AMD, Nvidia.
Yeah. all of this just screams market crash, annihilation. The poor retail investor who doesn't understand risk management, who swings for the fences, they chase all the shiny, fastest moving stuff. I mean, this is what the market does. It literally herds people in, puts them in really crappy investments, just like 5X and leveraged, ETFs on stocks. All these poor retail investors just get lured in for big returns because they don't understand risk and many haven't been through a bear market or a reset. And then they just get blown up. I'm trying to save people from doing that. And it's pretty boring when you manage risk, which is why it's either you love or hate my analysis. You either want consistent growth and don't have to worry about what happens. We don't really care because we can navigate it. Or, you either like that or you think I'm the most boring trader ever and I don't have enough trades and I don't trade stocks and all of this stuff. So I can only help those who are open to, protecting their capital, protecting their lifestyle. But the markets are going to do exactly what they do every time. They suck everybody in. People get stuck in crappy investments. They blow up and people lick their wounds and they hate the stock market for the next 3 or 5 years. And they slowly limp back in over time, but they're mentally damaged from it. They're always scared. It's hard for them to get back into the markets because they're scared they're going to lose again. And the damage that huge losses do to your psyche really ruin you unless you've got like a star to follow, somebody or a strategy that can keep you on the straight and narrow.
Hey, Chris, why don't we talk about bonds just because we're talking about defense now during this market volatility. And let's take a look at the TLT, which is the ETF for the 20-year. It's up small on the year, but what are your views on this?
Yeah, I think bonds are trying to carve out a bottom. Now, I've never been an expert when it comes to interest rates and Fed and economic data. That's not my thing. I don't see a whole lot of value in it. I used to do it years and years ago, but I always found it very random. When you look at just the chart of bonds, they look like bonds are trying to put in a bottom. Where I'm torn is I think we've got, some people want a lower interest rate policy, but we also have inflation problem. I do think the inflation problem will change fairly quickly. I think once the momentum in the economy turned down, people's wallets are going to snap shut. The gouging for services, the gouging for products, the high cost of everything. Eventually things are going to have to come back down because people are going to have to liquidate their inventory. They're going to go out of business or they have to liquidate or they're going out of business and has to get liquidated. So eventually there'll be some reset. So I'm really torn on bonds. I feel like we still have high inflation, so rates aren't really going to budge. But then we also have somebody wanting, lower interest rates, which if interest rates go down, then TLT should rally. So to me, it is in what is kind of known as a stage one. If we just look at this, you and I have touched on this many times. The stage one is really kind of a sideways trendless. It's red on my charts here because it's a basing formation. It's trying to figure out what's going to happen. And bases can last years. And so it's dead money. And I'd rather put my money somewhere where there's no downside risk and earn a yield than hold on to something that potentially rates could go up and bonds could go down, or some maybe trust in bonds drops dramatically and we see the bond price drop. So I would steer clear of bonds for now. I'm not a big fan of them. And once they do pick once they put in a bottom and start to trend higher, I'll like bonds again. If they're trending up, I want to own them. Generally, if the stock market gives us a sell signal, you move over to bonds and bonds should go up. And we've been seeing that relationship more so in the last few months than we have in a very long time, in years, which means stocks go down, bonds go up. And so that's kind of what I'm waiting for. So I'm steering clear of bonds for now.
Okay, Chris, that was a great overview of the market. It looks like you're expecting some trouble here in the next couple of days, and it's going to be interesting to see these Nvidia numbers out tomorrow. If somebody would like to get in touch with you or check out your various services, where can they go?
Yeah, the best spot would be go to YouTube, my channel, The Technical Traders, or my website, thetechnicaltraders.com. And I share daily analysis videos. I cover what I'm doing with my portfolio, all my specific trades, all of that stuff. So you can learn how to read the charts. You can follow along and you can copy the exact same portfolio allocations and trades that I do.
Chris, once again, thank you.
Thanks, James. Always a pleasure. Take care.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next. Thank you all for watching. We'll see you again next time.